Check, please.
Welcome back. Tax season is approaching. I hate this time as much as you do. We will talk about H&R Block. They're going to get busy this spring. We'll show you the financials behind this company, what they make, what they do, where they're headed. We'll show you what stock price you could be paying moving forward using our amazing stock analyzer tool. Paul and Mo operate over $100 million in real estate, businesses, and stocks, and they will give you a mindset about investing with H&R Block, a former Little Book stock, a former 8-pillar stock. We'll show you the numbers right now. It's no longer in that sweet spot. Go ahead, Paul.
Thank you, Seth. Guys, follow us on our Instagram account, Everything Money Investing. It's growing like gangbusters. And also follow Seth, Mo, and I personally. We have great accounts where we talk about our dogs.
Speaking about accounts, Paul, I might be a shareholder in H&R Block. I just don't actually know. That's how little I've been checking my portfolio of late.
I was talking about Instagram.
I know. I'm just getting right to it.
So, guys, H&R Block was a company that I was a big believer in last year. I still own shares of it. Let's go to our 8 Pillars tools and start looking at H&R Block. All right. So, it's currently at $22 a share. Here is the stock chart for the since 1988. So, if you bought it in 2004, you're down. If you bought it in 2002, you're still down.
Jeez.
Ironically, in 2000, if you bought it at the peak of the market, you still have doubled your money, but it hasn't done very well.
This isn't a very disruptive company, Paul.
Obviously not. So guys, the market cap is $3.94 billion. Pillar number 1, we want the 5-year PE less than 22.5. It is 9.87. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is 0.6%. Massive X. They do a terrible job of getting a return on their invested capital. Now, that could be because our calculation of invested capital is based on the 5-year average free cash flow, which is down a lot. I imagine COVID was not very kind to this company, but either way. The dividend yield in the company is 4.9%, which pays out $194 million.
Can they afford it?
So, guys, if they can afford it, you look at their free cash flow. Over the last 5 years, they would not be able to afford it, but last year's free cash flow was $274 million. So it's still a big chunk. At least two-thirds of their free cash flow was used to pay out the dividend. All right. Pillar number 3, we want income growth. So we go to our income statement. We go to our revenue. We want revenue growth. 5 years ago, it was 3.05. Last year, 3.01. Guys, this company is boring as hell. 10 years ago, it did $2.85 billion. Last year, it did $3 billion. Very little growth, if any.
I did buy this on July the 1st of last summer as part of my Little Book stocks, the Joel Greenblatt Magic Formula, and it is in my portfolio.
What did you pay for it?
I'm down 6.5%.
Okay.
Yep.
But you've gotten 2.5% in dividend.
Okay, keep going.
So, pillar number 4, we want net income growth the last 5 years. So last year, $400 million 5 years ago. Last year was 340. That's an X. All right. So look at this net income. It's pretty boring and stable over the last 10 years. So, okay. Pillar number 5, we want shares outstanding staying the same or decreasing. If a company has 10 shares and you own 1, you own 10% of the business. If they buy back 2 shares, you now own 1 of 8, which is 12.5% of the business. So you did nothing but own your shares and they increased your percentage ownership of the company. So we go back, we scroll all the way to the bottom here. We go back to the 6th year, which is the beginning of the 5th year. They had 220.5 million shares. Last year, they had 178 million. Check mark there.
Very nice.
So I don't know how they're buying back so many shares, but eating up so much of their free cash flow with dividends. But that's something we have to look at. Pillar number 6 is their debt. So we go back to the main page. We look at their 5-year average free cash flow, 14 million. We multiply it by 5. We want this company to have $70 million in long-term liabilities or lower. That's going to be a doozy because of their big drop in free cash flow. So let's go to the balance sheet. Scroll all the way to the bottom. $2.6 billion in debt.
As you progress through these financials, Paul, I'm getting sadder and sadder. Keep going.
But remember, your job in the little book is to do something, follow the track, and stay with it.
Stay the process.
So, free cash flow is cash from operations less your capital expenditures. We do the great job for you guys of adding this free cash flow line to make the math easy for you. 5 years ago, they lost $750 million in free cash flow. Last year, made $273. That's a check mark there. And our final metric is not even useful. We take their 5-year average free cash flow, multiply it by 20 for a market cap to start with. 280 million. No, that's not right. Yeah, $280 million market cap. That's an X because their maximum market cap is like 2.6 billion. Guys, their free cash flow is so skewed by these last 2 years.
Oh, Paul, their market cap's $4 billion.
Oh, 4 billion?
Yes, it's
so
even worse.
Guys, look at this. But remember, they have $1.1 billion in losses in the first 2 years of the 5 years. So keep that in mind when you look at this company. The 8-pillar analysis, which we're going to show you right here.
UGLY.
You ain't got no alibi. So guys, this is all over the board. This is ugly.
Ugh.
When I bought it, what did we buy it at? 12 or 13?
Last year?
What did I buy it at? I think I bought it. I still have my shares. But this is probably the point now where I go, okay, is it time for me to sell them? Because it's not, is it going to generate enough free cash flow? Let's use our stock analyzer. Because remember, guys, every investment is the present value of all future cash flow. We created the stock analyzer tool, which has been the most popular part of our software, because what it does is it allows you to make assumptions about the future, since we don't know the future, and tells you what you should pay for the company today based on those assumptions. So let's go to the stock analyzer tool.
Oh, Paul, the stock analyzer gets deeper than you even think. I had about a 90-minute sit down when we were in Mexico with one of our community members.
Yep.
Who is specializing in options. And so she uses this stock analyzer when she's writing long-term options, 1-month options, to find those prices that we need to pay, which is always used to be so hard for me prior to being on this show. Is like,
oh, the puts. Yeah, I sell puts based on this stock analyzer tool.
Yeah, it's incredible. It all works.
I've talked about that.
I know. It's just someone else says it in a different way.
Okay.
She calls it cash flowing the market. Actually.
Oh, that's adorable.
I love that concept. It's anyway,
because you can make a really good return on puts if you're selling puts at lower prices at 10-15% just using that for your cash.
Yeah, keep going.
All right, so let's make our assumptions on H&R Block. All right, so I'm going to go negative 0.5, 0, and 0.5 in terms of growth rates. So I'm having decline, stay the same, and slight increase. Profit margin, I'm going to go 11, 12, and 13. Free cash flow margin, I'm going to go...
Go on.
8, 8.5, and 9. PE. Guys, I'm going to pay a really cheap PE. 8, 10, and 12. 8, 10, and 12. And then desired annual return, 12.5%. Why do I pick 12.5%? Guys, you can invest in an ETF and make 9 or 10%. So in order to invest in an individual stock with margin of safety, increase your returns, that decreases the stock price. You can never, ever, ever change what you paid for a stock without exiting it. So once you buy it, that number is set in stone. So your job is to buy it. It's to be conservative and look at it from a conservative standpoint and buy at a lower price. Hit the analyze button. All right, guys. We have a low range of 10 to 14, a high range of 14 to 20. This is a very tight range. This company ain't moving much in terms of value. Why? Because the revenue growth isn't there. So it's currently overpriced all the way around. But if you can buy it in the low teens, I want to look at where I bought it at. It was way lower than this. I just don't remember where I bought it at.
And the 52-week low is 15.
I bought it before. I bought it in 2020.
Mm-hmm.
I bought it in 2020.
So what does Joel Greenblatt's formula see in this stock, or what did it see?
Well, it must have been a more recent high return on invested capital, as well as a PE that was low.
Yeah.
Our return on invested capital is based on a 5-year number. Most people do it based on a 1-year number. I'm doing it based on a 5-year. And remember, there are multiple ways to calculate the return on invested capital. The way I've chosen is through cash flow. So
the process I'm having is I'm going to be stuck with this stock through July of this year.
Yep.
It's funny if you watch YouTube out there, folks, and these guys, Paul, they're exploding. You got to load up on this innovation, this disruptive, this is the best thing ever. And here I am, this dummy investing in H&R Block. But you got to stick with, but again, I was guessing in the past, when I was investing in companies and following that hype train, you're just sort of guessing. But so even if my process is failing me on this company, the goal is it does better in other ones, of course.
Of course. Your job is to play the averages. Just like a baseball player can go to the Hall of Fame batting 300. Your job, you can go to the Hall of Fame in investing by batting 400. You will kill it.
I guess you're right. In another boring company, HPQ, I'm up 26% since I bought. So they balance each other out a bit. But so if you want the software behind Paul, if you want to make better financial decisions like I have been learning to do, you can grab it and Paul will tell you right now how to do so.
And the reason we created all this software is because as we made videos of the company, people would reach out to us and say, hey, how do I analyze my own companies in order to do the analysis versus waiting for you guys to make a video? So we created the software. You get everything you saw here. You get everything on the main page that's also coming soon, right here to the right side. You get 30 years of financial data. You get access to Seth, Mo, and I in our exclusive Everything Money chat here at the top, EM Community Chat. You get the Stock Analyzer tool. You get Real Estate Calculator, Retirement Calculator. You get 8-pillar portfolios, which allows you to put up to 50 stocks in a portfolio to tell you how all 50 companies do at once, or 20 companies, doesn't matter. But exclusive daily content. We make 1 to 3 videos a day that we post. They're called A Few Good Minutes. They're wonderful. Seth, Mo, and I make them. But most importantly, guys, is this EM community. We have over 6,000 people that constantly talk in the community about their investment ideas, because the great thing about the internet is it allows all of us who have a certain way of thinking to come together and talk about our investment ideas. We have people in there saying, hey, I'm looking at blah, blah, blah. I'm looking at Ford stock. What do you guys think? And people have a good, engaging conversation about it. This is all available, all in our tool, all of this for about $1 per day. Sign up now. $1 per day gets you all of this. For the price of a cup of coffee, you get all of this, $1 per day. Sign up. And the best part is, whatever you sign up for today, that's your price that's locked in, because the price goes up every single month. But you're locked in at the price you sign up for today. So $1 a day gets you all of this. No brainer, guys.
Okay, that's our take on H&R Block. Get your taxes done. For my sake and my portfolio, please use H&R Block. I need all the help I can get. But that is our take. Get the software. You'll love it. And I'll talk to you guys in the community. We'll see you next video.